If you study economic history closely enough, you begin to notice something fascinating and also deeply unsettling. The same patterns repeat again and again across generations, across continents, and across entirely different political systems. Economies expand, credit grows, governments spend aggressively, and eventually the system reaches a moment where the rules change. In those moments, the biggest financial mistake people make is not losing money in risky investments, it's doing nothing. It's letting money sit still while the system around it shifts. We are rapidly approaching one of those moments, and if the economic signals we're seeing today continue along the path they're already on, the year 2026 could mark a turning point that many people are not prepared for. This is not a sensational prediction or a dramatic headline designed to scare you. It's simply the logical outcome of forces that have governed economies for centuries. When you understand those forces, when you recognize the cycles that repeat throughout history, you begin to realize something important. Keeping your money idle during certain phases of the economic cycle isn't just inefficient. It can quietly destroy years, sometimes decades, of financial progress. Today, I want to walk you through exactly why that is happening, why the coming years could amplify this effect, and most importantly, what you can do to protect yourself before the consequences become unavoidable. To begin, we need to accept a simple but uncomfortable truth. Money, in the form most people think about it, is not as stable as it appears. I'm not speaking philosophically here, I'm speaking in purely practical terms. The dollar you hold today is not the same dollar your parents held decades ago, and the dollar you hold now will not have the same value 10 years from today. Consider a simple example. If someone had placed $100,000 under their mattress in 1980 and left it untouched for over 40 years, that money would still physically exist today. Every bill would still be there. But its real purchasing power would be dramatically smaller. Adjusted for inflation, that same $100,000 would now buy roughly what $30,000 could buy back in 1980. The money didn't disappear, the numbers didn't change, but the value of that money slowly eroded over time. This process has a name, monetary debasement, and it is one of the most powerful cycles in economic history. Whenever governments face extraordinary pressure, whether from war, recession, financial crises, or large-scale emergencies, they tend to respond in the same way. They expand the money supply. This pattern has repeated itself countless times. It happened during the Great Depression. It happened during World War II. It happened during the financial crisis of 2008. And it happened again on an even larger scale during the global pandemic beginning in 2020. Between 2020 and 2022, the United States created more new money than during any comparable period in its history. In fact, the amount of money injected into the financial system during those 2 years exceeded the monetary expansion of the previous 2 centuries combined. Think about that for a moment. More than 200 years of monetary growth surpassed in roughly 24 months. When changes of that magnitude occur inside an economic system, they do not disappear quietly. The consequences unfold slowly, and often with a delay of several years. And that delay is exactly why the years ahead, particularly around 2026, could become so significant. To understand why, it helps to think of the economy as a giant machine, a clock made up of multiple gears working together. One gear represents productivity, how efficiently an economy produces goods and services. Another gear represents credit, the borrowing and lending that fuels expansion. Another represents inflation, the change in the general level of prices. Another represents employment and wages. When all of these gears move at balanced speeds, the system functions smoothly. Economic growth feels stable, predictable, and sustainable. But when one or more gears are forced to accelerate artificially, the balance begins to break. Over the past several years, several of these gears have been pushed far beyond their natural pace. Interest rates were pushed near zero, dramatically accelerating the credit cycle. Governments distributed stimulus payments that boosted consumer spending far beyond normal levels. Central banks purchased massive amounts of financial assets, injecting unprecedented liquidity into markets. Each of these policies served a purpose during the crisis, but they also created distortions. Now the system is entering the adjustment phase, and throughout history, adjustments like this tend to follow a consistent rule. During periods of monetary expansion and inflation, real assets tend to preserve value, while paper money slowly loses it. When we talk about real assets, we're referring to things that retain usefulness regardless of how much currency exists in the system. Shares of productive companies, real estate, commodities, precious metals. These assets represent real economic value. They produce goods, provide services, or serve essential roles in the functioning of society. Paper money, on the other hand, represents a claim on value but not value itself. Cash in a bank account, low-yield savings deposits, fixed income securities that do not adjust with inflation. These instruments may feel safe because their numbers remain stable, but stability in nominal terms can hide a gradual loss in real purchasing power. And as the coming years unfold, the difference between these two categories could become increasingly dramatic. To understand why this happens, we need to take a closer look at how inflation actually transfers wealth inside an economy. Because inflation isn't just about prices rising. It's about who receives new money first and who receives it last. And once you understand that mechanism, the risks of leaving money idle become much clearer. Because inflation is not simply the story of prices going up. At its core, inflation is a quiet but powerful transfer of wealth. It shifts purchasing power away from those who hold money and toward those who own assets. Most people experience inflation only as higher grocery bills, higher rent, and rising energy costs. But the deeper mechanism behind it is something economists have understood for centuries. When new money is created, it does not spread evenly across society. It enters the system through specific channels first, usually the banking system, government spending, and large financial markets. Banks receive liquidity. Financial institutions gain access to cheap credit. Corporations borrow at favorable rates. Investors deploy capital into assets. Only later does that new money gradually move into the broader economy, where workers, consumers, and retirees encounter its effects through rising prices. This process has a technical name, the Cantillon effect, named after the 18th century economist Richard Cantillon. But you don't need to remember the term to understand its implications. The important point is simple. Those closest to the source of new money benefit first. They can purchase assets while prices are still relatively low. Those further away from the source feel the impact only after prices have already risen. Imagine two individuals in this system. One works in financial markets and receives early access to cheap credit and liquidity. The other works a salaried job and receives the same paycheck every 2 weeks. When new money floods the system, the investor may buy stocks, real estate, or commodities before prices surge. The salaried worker, however, sees prices rise before their income adjusts. The result is a gradual shift in wealth. Over time, asset owners accumulate more value while those who simply hold money fall behind. This isn't the result of conspiracy or malicious intent. It's simply the structural way modern monetary systems function. Now let's translate this idea into numbers that reflect the reality people are experiencing today. Official inflation statistics in recent years have hovered around 3 to 4% annually. On paper, that may sound manageable, but anyone paying attention to everyday expenses knows that the real cost of living has increased much faster in certain areas. Housing prices in many regions have increased roughly 25% over the past 3 years. Food prices have climbed around 20%. Energy costs in some periods have surged 30% or more. When you combine these pressures, the real inflation that households experience often feels much higher than official figures suggest. Now imagine someone who had $100,000 sitting in a savings account during that period. The number in the account may not have changed much, but the purchasing power attached to that number certainly did. In practical terms, that $100,000 may have lost somewhere between $20,000 and $25,000 in real buying power during those same years. Nothing was taken. Nothing disappeared. Yet the ability of that money to buy goods and services quietly shrank, and the economic incentives currently shaping the next several years suggest that these pressures could continue. To understand why, we need to look at several powerful forces converging at the same time. The first is government debt. The national debt of the United States has now surpassed $33 trillion, and it continues to grow rapidly. Servicing that debt, simply paying the interest on what has already been borrowed, now costs more than $1 trillion per year. That means a significant portion of the federal budget goes not toward new programs, but simply toward maintaining existing obligations. Governments have only a few ways to manage such massive debts. They can raise taxes, cut spending, or expand the money supply. Historically, the third option, expanding the money supply, has often been the easiest political path. The second major force is demographics. Every single day in the United States, more than 10,000 people turn 65. This demographic wave will continue for more than a decade. As millions of people enter retirement, spending on Social Security and Medicare automatically increases. These programs are not optional. They are built into the structure of government obligations. That means government spending will continue rising regardless of political changes. The third pressure comes from geopolitical competition. Global tensions, particularly with major powers like China and Russia, are driving significant increases in military spending, technological investment, and infrastructure development. These investments are often considered essential for national security and economic competitiveness. The fourth pressure lies within the banking system itself. Many regional banks currently hold large portfolios of bonds purchased when interest rates were extremely low. As interest rates increased, the market value of those bonds declined. In some cases, these unrealized losses are substantial. If financial stress forces those losses to be realized, governments and central banks may once again step in to stabilize the system, often through additional liquidity injections. When you combine these four forces, rising national debt, demographic pressures, geopolitical spending, and banking system vulnerabilities, you begin to see a common thread. Each of them creates incentives for continued monetary expansion, and the more money that enters the system, the greater the pressure placed on the value of money that simply sits still. To illustrate how this dynamic plays out over time, it's useful to look at history, because we've seen similar situations before. Let me tell you about two families living in suburban Chicago during the 1970s, a decade that shares several similarities with the economic conditions we may face again in the coming years. The Martinez family and the Thompson family started the decade in nearly identical financial positions. Both families had saved $50,000 in 1970, which was a significant amount of money at the time. But the decisions they made with that money would lead them down two very different paths. And the lesson from their experience reveals exactly why leaving money idle during inflationary periods can quietly undermine an entire decade of financial discipline. The Martinez family believed in safety above all else. They had worked hard for their savings, lived responsibly, avoided unnecessary risks, and followed the financial advice that many people considered sensible at the time. Their $50,000 was placed into a traditional savings account that paid about 5% interest per year. On the surface, it seemed like a smart and responsible decision. The money was secure, it was earning interest, and there was no exposure to market volatility. The Thompson family, on the other hand, made a different choice. They had an uncle who had spent years studying economic history, and he convinced them that inflation during the 1970s could be more destructive than most people realized. Instead of leaving their entire savings in a bank account, they divided the money into several types of assets. Some of it went into stocks, some into real estate, and a portion into precious metals. At the time, this strategy seemed far riskier. Stocks could fall, real estate prices could fluctuate, gold prices were unpredictable. Many neighbors thought the Thompsons were making unnecessary gambles with their savings. Now fast forward 10 years. By 1980, the Martinez family's savings account had grown from $50,000 to approximately $81,000. That represented more than 60% growth over the decade. From a purely numerical standpoint, their savings appeared to be doing well. The number in the account was larger than when they started, but there was a problem they hadn't fully considered. During that same decade, cumulative inflation in the United States reached about 112%. This meant that the purchasing power of the dollar had been dramatically reduced. Although the Martinez family now had $81,000, That money could buy less than half of what their original $50,000 could purchase 10 years earlier. They had done everything that conventional wisdom recommended. They worked hard, they saved diligently, they avoided risk. And yet, in real terms, they had become poorer. The Thompson family experienced something very different. Their investments moved through the ups and downs of the markets during that decade, but the assets they held, stocks, real estate, and precious metals, tended to rise alongside inflation. By 1980, the value of their portfolio had grown to around $195,000. Not only had they preserved their purchasing power, but they had significantly increased it. The real value of their savings had multiplied. This story is not unusual. In fact, it reflects a pattern that has appeared repeatedly throughout history, whenever economies move through prolonged inflationary periods. When money is losing value, holding assets that rise with inflation becomes essential. But the lesson becomes even clearer when we look at more extreme historical examples. Consider Germany in the early 1920s. After World War I, the Weimar Republic faced enormous financial pressure. The government had massive war reparations to pay and limited economic capacity to generate revenue. To manage the crisis, policymakers turned increasingly to money printing. At first, the changes seemed manageable. People who held German marks in savings accounts believed they were acting prudently. The numbers in their accounts still existed, and banks continued to operate. But as the money supply expanded rapidly, the value of the mark began to collapse. Prices started rising faster and faster. What had once been manageable inflation turned into something much more dangerous. Eventually, the value of the currency deteriorated so dramatically that people needed wheelbarrows full of cash just to buy basic goods like bread. Who survived that period financially? Those who owned real assets, land, buildings, productive businesses, gold, and even basic commodities like food and fuel. Who suffered the greatest losses? Those who held their wealth in cash and bank deposits denominated in marks. Now, to be clear, I'm not suggesting that the United States will experience hyperinflation on the scale of Weimar Germany. That type of collapse requires extreme political and economic breakdown. But the underlying principles remain the same. Whenever a system produces more money faster than it produces goods and services, the value of that money declines. And when that happens, assets tied to real economic activity tend to preserve value better than idle cash. Let's bring this discussion back to the present. Imagine you currently have $100,000 sitting in a checking or savings account. If inflation averages around 3% to 4% per year, that money is quietly losing $3,000 to $4,000 of purchasing power annually. But if inflation rises to 6% or even 8%, which is entirely possible during periods of economic adjustment, the loss becomes far more significant. At 6% inflation, that $100,000 loses $6,000 of purchasing power every year. Over 5 years, that becomes $30,000. At 8% inflation, the loss reaches $8,000 per year, or $40,000 over 5 years. And remember, these losses are not visible in your bank balance. The numbers in the account stay the same. The damage happens quietly through the erosion of what that money can actually buy. Now multiply those numbers by your own situation. If you have $200,000 in idle savings, double the impact. If you have $500,000, multiply the loss by 5. For people approaching retirement, this can become especially dangerous. Imagine someone planning to retire in 2030 with $1 million in savings. If inflation averages 6% annually, that $1 million will have the purchasing power of roughly $750,000 in today's terms by the time retirement arrives. That difference could determine whether retirement feels comfortable or financially stressful. For younger individuals and families, the long-term impact can be even more dramatic because time amplifies both gains and losses. And once you understand how compounding works in both directions, the consequences of leaving money idle become even clearer. Consider a young professional who is 35 years old and has managed to save $50,000. Wanting to be cautious, they decide to leave that money sitting safely in a savings account until retirement. It feels responsible. The money is secure. There is no risk of market volatility. and psychologically it feels comforting to see the same number sitting in the account year after year. But the real danger lies in what that number will actually represent decades from now. If inflation averages just 4% per year, which historically is not unusual, the purchasing power of that $50,000 will steadily decline over time. After 30 years, by the time this person reaches retirement age, that money would have the equivalent purchasing power of less than $15,000 in today's dollars. In other words, what feels like a safe financial decision today could quietly erode most of that savings over the course of a working lifetime. Now consider the alternative. If that same $50,000 were invested in a diversified portfolio of assets that historically outpace inflation by 4 to 5% annually, the outcome becomes dramatically different. Over the same 30-year period, that $50,000 could grow to $200,000 or even $270,000 in real purchasing power, adjusted for inflation. The difference between those two outcomes isn't small. It's the difference between entering retirement with financial stress or with financial stability. And this brings us to a crucial principle. The goal of investing is not simply to maximize returns. The real goal is to preserve and increase purchasing power over time while managing risk intelligently. With that principle in mind, let's talk about practical steps. This is not personal financial advice, because every individual situation is different, but there are fundamental principles that have proven effective across many economic cycles. The first principle is diversification. You've probably heard the phrase, "Don't put all your eggs in one basket." That advice is still correct, but it needs an update. It's not enough to avoid concentrating everything in one investment. You must also avoid concentrating everything in the wrong type of basket. In the current environment, the basket that carries the greatest long-term risk may be idle cash. Cash still has an important role. It provides flexibility, emergency reserves, and liquidity during uncertain times. But holding too much cash for too long in an inflationary environment can be financially destructive. A basic structure for protecting against inflation often includes several categories of assets working together. One large portion typically consists of shares in high-quality companies. Businesses that produce essential goods and services tend to adjust their prices when inflation rises. Companies with strong brands, loyal customers, and pricing power often maintain their profitability even when costs increase. Another portion may include real estate, either through direct property ownership or through investment vehicles such as real estate investment trusts. Real estate historically tends to rise with inflation because property values and rents often increase alongside the broader price level. A third component can involve commodities and precious metals, such as gold and silver. These assets have historically served as stores of value during periods when currencies lose purchasing power. Another category includes inflation-protected bonds, which adjust their returns based on changes in inflation rates. And finally, a smaller percentage of the portfolio should remain in cash or liquid assets, providing flexibility for emergencies and opportunities when markets present attractive entry points. In many diversified approaches, this liquidity portion might represent around 10 to 15% of the total portfolio, enough to provide security and flexibility, but not so much that inflation steadily erodes its value. Of course, not all investments perform equally well during inflationary periods. The strongest protection tends to come from companies and assets that can pass rising costs on to consumers without losing demand. Businesses that produce essential products, food, utilities, infrastructure, and certain technology services often fall into this category. Real estate in high-demand locations can also perform well because housing remains a basic necessity. On the other hand, some investments struggle during inflationary environments. Companies carrying large amounts of debt may face rising interest costs. Businesses operating in highly competitive industries may struggle to raise prices without losing customers. Similarly, fixed-income investments that offer low yields without inflation adjustments can lose purchasing power rapidly when inflation accelerates. Another critical principle is liquidity and adaptability. Economic cycles constantly evolve. What works perfectly in one decade may perform poorly in the next. Maintaining some portion of a portfolio in assets that can be quickly adjusted allows investors to adapt as conditions change. This might include diversified funds, liquid exchange-traded funds, or even temporary cash holdings during transitional phases. One of the most important lessons from economic history is that timing the market perfectly is nearly impossible. No one can predict exactly when inflation will accelerate, when markets will correct, or when economic conditions will shift. Instead of trying to predict the precise moment of change, a more effective strategy is gradual positioning. Implement changes slowly over 6 to 12 months rather than all at once. This reduces the risk of making decisions based on short-term market fluctuations and allows adjustments if new information emerges. Your time horizon also plays a major role in determining the appropriate strategy. If you will need your money within the next 2 to 3 years, maintaining a conservative reserve may be sensible even if inflation erodes some value. Short-term market volatility could pose a greater risk in those situations. But if your investment horizon extends 5 years or longer, accepting some volatility in exchange for inflation protection becomes far more reasonable. Because over longer time periods, the compounding effects of growth tend to outweigh temporary market fluctuations. However, implementing an investment strategy is only the beginning. The real challenge lies in maintaining discipline over time and avoiding the common mistakes that repeatedly undermine investors. And those mistakes tend to appear in predictable patterns.